We will get today's presentations underway now, and first up on stage we'll be hearing a presentation about the ultimate way to succeed in FX trading, how to develop a winning mindset. And to give that is Ali Mortazavirad. He is the VP of Market Analysis and Education at Inveslo, MTFGX. Ali, if you'd like to come up, welcome to the stage, and I'll let you take it away, first session of the day.
Hello everyone. It's great to be here in this great event at the Forex Expo in Dubai. Very good. Okay, firstly I'd like to thank MTFXG, the newly established broker, to invite me as a guest speaker on this side of the Inveslo. And I'd like to mention that the MTFXG group established by finance professionals who have been in the financial industry around the corner actually for over 15 years in a different part of this industry. They have wealth of experience in blockchain. This is their expertise, and now they are going to launch their Forex company later this year, mostly actually likely in the October. So I'm really happy to be here among the professionals and the good fellows and the traders. Let's start and see what we have here. Okay. As the topic suggests today, we are going to discuss developing a winning mindset, which is the ultimate way to success. Is it? Okay, yeah. The ultimate way to success in FX trading. People think that trading success has to do with some sort of let's say, secret formula or some magic techniques. Let's say a holy grail, everyone trying to find the holy grail in the financial markets. They say, okay, you find the formula and boom, you will get rich at the second at the snap. But actually, success in Forex is all about consistency because the trading is a simple process. But the problem is that it's not easy to follow the winning approach in long term. In this presentation, I will cover the steps needed to build up a real solid winning trading approach to set you up on your way to success, and also be talking of how you can stick to your plan constantly, which is the most important, the most crucial part of the FX trading. So you have to keep in mind that actually constancy is the key. We would start with the trading plan. The difference between making money and losing money in Forex can be as simple as trading with a trading plan or without a trading plan. You see, this is our roadmap to constant success. And the idea is that we would need something concrete. Now, and a structure that we could refer to before we take the trade and also after taking a trade. It's not only before the trade, it's also for after taking a trade to either review how things went and look for ways that we could change it or to determine if the trade is setting up for us to even get into it. So from this perspective, a trading plan as a roadmap is there to help us decide what, when, and how much to trade, and when to stop for the day. By asking these questions, we can make a plan that suits us. And let's get through some details about this trading plan. Let's start with the strategy as the first part. The fact is the market offers an endless number of trades to make, but what we want to do is, let's say we just want to end up making the few trades that offers us the highest probability of success. This is what we want to do. This because we are in a market to make money. There are two boxes containing all answers we need to know. And we can have these boxes both in our trading plan. You see here the trading strategy and money management as the two crucial parts of each trading plan. By using trading strategy and money management rules, we are trying to filter out every high-risk trade and only end up with low-risk, high-probability trades. Still, the most crucial part is sticking to our plan. Yeah, we can see here, which I call mastering the art of discipline. This is the most overlooked part of each trading plan. You see, many traders, many people who are talking about the trading, they don't talk about, they all talk about the strategies. How can we enter the market? Where is the holy grail of the market? How can we find the formula that can make us rich in a second? Or some people just mention to the very simple rules of the money management that, okay, we have to take care of our risk in the market, but no one talking usually about the discipline. But the discipline is the most crucial part of the trading, I would say, and I would say this is the holy grail, as let's say the holy grail of the market is having a disciplined plan for trading. Because, you know, the excitement of real-time trading and the thrill of seeing an investment rise or fall can sway anyone. That's why practicing discipline to stay with a trading plan is crucial for running long-term success. But let's back to the strategy, because we are going to get a close look to all of these parts one by one. At the first step of trading Forex, we have to make a checklist of predefined reasons and criteria used when making trading decisions. Your strategy should give you a set of rules and enables you to identify high probability setups on a repeatable basis. It's very important. That's why we have to keep it very simple. You know, each trading strategy also, let me see what, has 3 parts. We have to keep it very simple because we have to be able to actually make it on a trade, to apply it on our trade, to find the opportunities in the wild market movements. So we have to be so fast and so cute. So it's very important to keep it really simple. Your strategy should give you a set of rules, okay, that enables you to identify high probabilities setups on a repeatable basis. Then when the trade is presented, we can take it with full confidence. And then we have the take profit level. This is a key way to lock into profit when a profitable trade runs its course. Actually, before the market turns against us, you see many times these things happen. That's sometimes we say, okay, oh, I wish to close my trade there, for example, and then you see after that, by the way, market keeps moving against you. So, but it's not all the thing. The most important part of each strategy, trading strategy, is identifying, or let's say the predefining of our stop, because we have to be able to manage. You see, we have to find out the ways to exit profitable trades and also exit the losing trades, because we have to be prepared for the market. We can't, let's say, we can't make sure that what will happen in the market in the next move. Nobody knows that. But we can actually manage all of these scenarios by using the take profit level and the stop loss level, because trades don't always go the way we expect. So we need a parachute, actually, to cut our losses at the level that we know the market will reach if we are totally wrong. So I actually brought my one of my favorite trading strategies here. I'd like to share it with you. I need for example, to enter the market, this is my idea for entering the market. I need to identify a prior trend forming a reversal pattern on the chart to open a position. After that, I look for confirmation from 2 or more oscillators and indicators like a linear weighted moving average and RSI or momentum. So what does it mean? It means I must enter the market only when the price meets all the conditions. For being sure of that, I should write down my reasons, one by one. As you see here, it's necessary to prevent getting confused in quick market movement that I really want to put, insist of it, because it's very crucial, guys, to write down all of these rules for yourself, because you have to be aware of what you are going to do in any different market condition. So it's not the whole story. After that, we need the exit rules. So I also determine my stop loss and take profit levels beforehand. I will put the stop underneath the last opposite swing and project the target using Fibonacci levels, which is a very popular and reliable way to control the trade. Let's say I managed to close part of my trade up to 261.8% Fibonacci level. This is my trading strategy, which mean I don't enter the market unless I see all conditions are met by the price. And let's illustrate it on the chart here. Yes. Here on the chart, for example, you can see how does the specific rules give us an overall roadmap of entering and exiting the market. The price must abide by all these conditions before we enter the trade. It's very important. And until that happens, we just constantly watch the price moving. We do nothing. We are not supposed to do every opportunity to put on a trade. We are not supposed to do that. We just need to watch the price. And once everything lines up, we will enter and set our take profit and stop loss level as soon as possible. So, for example, here, you see beautiful down trade here. This is my first condition that is met by the price, and the price is going to breach the neckline of this triple pattern. Actually, if you can see my laser point here, you see here a very beautiful and pure, actually, triple bottom pattern on the chart. So price is trading above the WLMA. You see that, what does it mean? Which is a sign for probable bullish momentum, maybe. And as the fourth bullet point here, the divergence between price and RSI suggests the downtrend momentum is waning. So I enter the market here and put my predefined stop loss and determine actually my take profit before starting the trade. These are all before enter the market. It's very crucial to know, because after I see that breakout above the, let's say, the neckline of the reversal pattern, I can be sure by these oscillators and the LMA that, okay, it would be it might be actually a right time to enter the market. So before I open my trade, I have to identify first my stop loss and take profit. That's two scenarios. So this is the first level of each, let's say, the trading strategy. And after that, I just watch the market to do its job. Now the question is, how much money should I put in the trade? This is the second part of each trading plan. Okay, maybe I found a very beautiful trading opportunity on the chart, but what should we do next? How much money should I put in this trade? To answer that, actually, we need to apply money management to our trade. The money management, guys, will give us the pure and very correct and clear answer. Yeah, you see, I just need to watch what's going to happen in the market. But in the case, if the market moves against me, no problem with that, because I will get sure that the trend will back to the down, and the downtrend will be intact if my stop loss reached by the price. So in that case, it's better, it's the final point for me to get out of the trade. So we have to get out on the trade at that, because I likely to be right, but not always. I can be wrong. So, and any trader actually can be wrong. So this is our scenario. We just after that need to watch the market and see what is happening after that. So to decide of how much money we can put on a trade, we can find the answer of this question by looking at the money management principles or rules that we are going to break it down here to actually one most important part, which is the position sizing of a trade that you might be familiar. Anyone who is trading in financial market knows about the position sizing, and so I will just pass it quickly a bit. Money management refers to the set of rules to calculate our position size, which aims foremost to mitigate the risks. It's very important because we have to control the risk. We can't, we can't escape the risk in the market because trading involves risk. That's it. But we have to mitigate our risk while magnifying the returns. This is the secret of being a winning trader in financial market. This is the most essential part of our trading plan. Without restricted money management rules, we can eventually end up losing, or maybe end up blow up our account, And no matter how good our trading strategy is, you will see in a few minutes that how it works. The size of each position is relative to our account size, the first, and to our risk appetite and to each individual trade where the stop loss is placed. So firstly, we need to determine how much of our capital we are prepared to lose on a single trade. This is the most crucial, let's say, the most crucial question. We have to find the answer for that. How much money I'm prepared can I take to lose in the market? And we have to determine all of this information before opening any kind of trade, okay? For example, 1% of my old capital, can I take that kind of risk? 1%, 2%, 5%, we will get it later. And then we have to consider the trading occasion. We have to back to our chart to see the distance between our stop loss and entry level, which is the pip at risk. So that would be the second part of our money management, or second condition. We have to regulate it in the market as the pip at risk. So first of all, the risk per trade, the maximum potential loss we can take, and then the distance between our stop loss and take profit. We have to determine both of them to get the right position size. Okay, it's recommended to not put more than 5% of all of your money in one trade. No, it's not. It's not the right way to get rich only by 1, 2, 3 trade. I will show you actually later, and I will prove it to you by the magic of the maths, let's say, or the statistics. Here is how we can calculate the right size of the position. Here is an example. Let's take a look at the example here. With a capital of 10,000, a risk per trade is up to 2%, or let's say the $100. We're going to buy USD CHF at the given price, and the trading setup suggests putting our stop loss 20 pips below our entry level, as we discussed in our trading strategy. So to minimize our risk to $100, we're going to take 100 divided by 0.0020, or 20 pips. This is the formula to get the right size of the position. which gives us the 0.5, or let's say the half a lot. It means if we buy half a lot USD CHF, we lose only $100 in the event the market goes against the trade. And here's our stop loss. So we can assume this is a good deal for us, and so it will give us more confidence to start our trade. But you see, the formulas are very simple. You just need to divide 1 to 1, okay? It's very simple. And the trading strategy is also sometimes works, sometimes actually not working. But the most crucial part that we want to discuss is mastering discipline. We will see how we can actually keep ourselves on track with our strategy, and how can we define if we are making money of putting all of this effort in the market, trading, the money management rules, our strategy, and actually all of this stuff. As you saw this, it's not so far. It's not hard so far. So mastering the trading plan is not possible without mastering discipline. After building a trading plan, we must stick to it and keep it on track to improve the constant learning and constant improving and having a realistic expectations. So we have to learn about the market all the time. We have to test the new strategies all the time. We have to test the new return to reward ratios all the time. We have to be actually consistent learning in the market, and after that we need to be consistently improving ourselves, improving our strategies, improving our risk management. But we should keep in mind, okay, the expectation of making money in Forex should be very, very realistic. We have to be very realistic on that. And I will show you. Oh, I found out the screen's here, so I don't need to turn my head. Yeah, very good. Okay, so here is a question actually coming up. Should we put our time to find the best trading strategy, or should we take the maximum risk to get the maximum gain per trade? What should we do? We can have a very great, should we go to find the best trading strategy, or should we go to find the best risk management, restricted rules for our risk management? Which one can help us to be successful in trading? We can use the trading expectancy. As you see, trading expectancy is a primary trading performance metric that is required to really assess our trading plan and track our progress as we trade it. Now we have the last piece of our puzzle to find the answer and develop a winning mindset. Or let's say, after building a trading plan, it's time to determine whether our trading plan is profitable. This is the way we can actually examine it, put it in action. Okay, according to the definition, you see the trading expectancy is the expected average profitability for each trade based on what your plan has already made, and is calculated like this: the percent of profitable trades times the average profit earned minus the percent of losing trades times the average loss made per trade. But you will see how it's gonna help us. You can track the average win and the percent win, and as you trade more, you will find out how your percent win moves or changes as time goes by. You see, let's say the expectancy describes an average, but you can break it down into two components. You see, let's say one is the average win, and the other is the percent win. And let's see how it's going to help us to have the best profitable trading plan. There, you have to look at your percentage win and figure out what's going to take to raise that increase your expectancy, which is highly depends on your trading strategy. Or maybe you can just track the average win, as I told you, and the average actually, the average win. You can just track it. And let's go through the examples. First of all, I'd like to mention that the trading expectancy needs to be greater than 0 to have a winning plan. Okay? It simply means you need to profit more than you lose over a series of trades, which is very important. Here we have the result of two trading plans. You see the trading plan A has the average win size twice the loss size per single trade. However, the profitable trades are half of the numbers of losing trades. And you can see that this plan ends up in 500 of loss after 100 trades. You see the formula suggests here the expectancy is below the 0. It means we lose $5 on average per trade. So this kind of trading plan is not profitable. But let's take a look. No, it didn't work. Okay, let's take a look at the second plan, the plan B. Conversely, trading plan B. It has an average win size, half an average lose size. The win size here is greater, okay? Still, the profitable trades are constantly at a higher rate, which is very important. And eventually, the plan makes $500 over 100 trades. It means you can make money, and on average, $5 per trade. What does it mean? As a result, we can say expectancy demonstrates that a winning plan is one that can produce a consistent profit over a series of trades. Not the one has greater win size per trade. You see? So it gives us a hint, actually, how to manage our plan and how to trim our plan when we see frequency and persistency is the key to make money over time. Okay, we're going to out of time maybe. Here is another situation that emphasizes the importance of improving win rates on the determined return to risk ratio. It's showing that if our trading plan has a win rate of only 40% and a return to risk ratio is 1.6, we still can make $4 per each trade. Let's say these are the numbers, guys. You know, by the way, it doesn't mean by changing these numbers you can get rich, but it illustrates how marginal adjustments can boost our performance in the long term. Interestingly, if we improve the win rate by only 10%, our average profitability would rise 720%, which is impressive, yeah? We can expect to earn $30 on average if we just win half the trades we take with the 1.6 RR ratio. And what does it mean? The message here is that we don't have to be right all the time in the market, which is impossible way, yeah? And we don't have to know exactly where the market is going most of the time, even most of the time, 50-50. We just have to manage our risk and stick to our plan, keep it adjusted, and actually be selective to our trades. This is the only way to make money, to gain from the Forex trading. And thank you. As a conclusion, I would like to wrap up everything to point out the advantage of having and improving a trading plan. You see, it's the only way to cut your unexpected losses in wild market movement by putting a stop loss on each trade. And it helps you to track your trading history and prevent getting a stop out from the market, because when you can adjust your trading plan, you can be aware before opening any trade, and it will keep you preventing of getting stop out. That's very often, you know, in the, let's say, the margin trading when we use the leverage on FX products. And we can say you will stand one step ahead of the market by expecting unexpected, because you have a plan for losing trade and for winning trade. And we can say it makes you feel confident about your trade and keep you beyond emotion, which is a key, actually a very crucial part for being a trader in this, the most volatile actually market in the world for a long term. And that's it. Thank you so much. Thank you for your attention. Thank you.